So let's start with bullish sentiment. What's your point here?
So I track investor sentiment. What I've done is I put it on charts and I have it here. And basically the lower part of this is the market sentiment, currently at 75%. When it's above 70, I call it the elevated zone. When it's above 80, that's an extreme zone. And one thing about sentiment is that it's a condition and not necessarily a trigger. And back in April, you can see it got down to 10%. It's easier to make bottoms than tops, and it can stay elevated in that condition for a certain amount of time. There's a red line in there too. That's the 20-day moving average of bullish sentiment. So we're still elevated with market sentiment. And that to me is, it's getting late. Again, it can stay elevated. It can stay depressed as well. And I track from equity market to bonds, currencies, and commodities as well. Every day we get this data. And I think the charts do a pretty good job of laying it out.
Sentiment's always a very interesting thing. And again, sentiment does stay overbought for a very long time, and particularly when you're in a trending bull market. Bottoms are great. When sentiment gets really, really negative, like we saw back in April, that's pretty much a really good opportunity to put capital to work. We have a lot of sentiment gauges that we track internally as well. And back in April, those were hitting readings we hadn't seen since really the financial crisis, hitting some of those lows.
Yeah.
You cannot not buy here. Yeah, it may go down a little bit more, but when you have that kind of negative sentiment, that's generally a really good opportunity. But to your point, it gets a little more challenging when you're in a kind of a trending bull market, because it can just stay that way for a long time. And you're just like, hey, markets are going to sell off here, but when? That's the question.
If tops are a process, I think the process is really starting here, and it's lined up to where you have things all stretched on one side. One thing I track, I use DeMark indicators, and you'll see those 9s and 13s are the significant numbers. The red ones are the sequential, the purple ones are the combo. When you see those numbers, you usually will get a price reversal or at least a stall after those. And it takes 10 to 12 days on the dailies and maybe 6 weeks on the weekly. So this right here shows the S&P was under 20 times earnings back in April. And that, again, a level where I was pretty confident buying and shifting to the long side. So it's trading, and I use the Bloomberg best PE ratio, and it's trading at 25 times earnings. That's expensive. That's not necessarily where you want to be a buyer. The NASDAQ 100 is trading at 32 times earnings.
The Tom DeMark indicators, what they kind of measure and what they mean?
Basically track market exhaustion, and it can work on the upside and downside. They tend to work pretty well, and when they don't work, it's also indicative of the type of trend you have. Bottom line, with these elevated multiples here, and it's been margin expansion leading the way. So I think that we need a little bit more E in the PE ratio to even things out.
Catch me daily on The Real Investment Show. The link is in the description.